Technical analysis is a popular approach to trading in the financial markets. It involves using past market data, such as price and volume, to predict future price movements. Technical analysis is based on the idea that the market is not completely random and that patterns can be found in the way prices move. However, the reality of technical analysis is often different from what many traders expect. In this video, we will explore the truths of technical analysis and how to correctly approach trading to avoid common pitfalls. Have you ever felt like you've cracked the code to trading? Like you've discovered the perfect pattern that guarantees profit? Well, think again. The illusion of perfect patterns can lead traders to overlook critical market indicators, and the result can be disastrous. Unlike fundamental analysis, which relies on company financials and news events, technical analysis focuses on studying charts and patterns. It involves identifying trends, support and resistance levels, and price action to make predictions about where the market is heading. The illusion of perfect patterns. Technical analysis can be incredibly powerful in predicting market movements, but it's not foolproof. It's important to understand that it's a subjective process, and there are no guarantees in the stock or crypto market. Trading is an intricate and complex art, and while pattern recognition is undoubtedly an essential skill, relying solely on it can be a costly mistake. So, why do we fall into this trap of relying solely on patterns? Well, it's simple. As human beings, we have an innate desire to see order and make sense of chaos. Patterns give us a sense of control and confidence in the market, but they can also blind us to crucial information. Many traders strive for perfection in their trades, but when it comes to technical analysis, perfect patterns are often only seen in trading manuals. In reality, price movements can be quite messy and unpredictable. Relying solely on pattern recognition to make trading decisions is a mistake. It is essential to understand that the market is influenced by many factors such as buyers and sellers, stop hunting, liquidity, short squeezes, momentum spikes, and shock events. Price action is the result of the push and pull of supply and demand created by emotional, rational, and irrational players in the market. Therefore, it is crucial not to expect perfection on the charts you trade. The market does not stop and turn immediately in the opposite direction. In technical analysis, a market reversal is a well-known concept and the basis of many trading strategies. However, many traders don't know how to analyze a reversal. The market always has momentum and will almost always continue beyond the candle or candle pattern signaling a potential reversal. Thus, it is essential not to act immediately as soon as a reversal signal appears. Instead, traders should consider other factors such as trend lines, support and resistance levels, and the overall market context. Technical analysis should be used in conjunction with other market data to make informed trading decisions. The usefulness of technical indicators. Technical indicators can be useful tools for analyzing price information. However, many traders wait for the perfect setup where all indicators on the charts align, but more often than not, it's too late. Relying solely on indicators without first learning how to read price action is a mistake. Technical indicators should be used to analyze price information, but not as a substitute for understanding price action. Traders should focus on learning to read price action, using technical indicators as supporting tools, not the sole basis for trading decisions. Price action or trading indicators? The argument between technicians who think price action is the best way of analyzing the markets and the traders who think using technical indicators is the best way to trade is ongoing. The truth is that both price action and indicators have their strengths and weaknesses. Technical indicators are lagging indicators, meaning that they react to past price action. On the other hand, price action is a leading indicator, meaning that it gives traders insight into future price movements. It is essential to combine price action with indicators to take care of lagging issues. Context and confluence matter in technical analysis. The context and confluence of indicators matter in technical analysis. Most traders use their indicators in the wrong context, which can result in losses. Instead, indicators should be used to analyze price information and provide reference points. But, it is crucial to listen to what the price is telling you, and collect clues to combine them in meaningful ways. In addition, traders should consider the overall market context, including economic news, company news, and geopolitical events. Combining all of this information can provide a more complete picture of the market and increase the chances of making successful trades. Predictive versus reactive technical analysis. There are two types of technical analysis, predictive and reactive. Predictive traders establish a position when a technical price level is reached regardless of the price action. Reactive traders try to react very quickly when price begins to move or they get a signal. Reactive traders also try to beat the crowd, but they try to time their entries and exits with much precision. Both approaches have their advantages and disadvantages, and it is up to the trader to decide which approach suits them best. However, it is important to note that both approaches require a thorough understanding of the market, including technical analysis and other market data. The truth is, successful trading requires a multifaceted approach. It's not just about recognizing patterns, but also understanding market fundamentals, tracking news events, and managing risk. Technical analysis, an art, not a science. Just like a painter uses their creativity to create a masterpiece, technical analysts use their intuition and experience to predict market movements. One of the biggest criticisms of technical analysis is that it's too subjective. Two analysts can look at the same chart and come up with completely different predictions. However, that's also what makes it an art form. Despite many efforts to make technical analysis objective, it remains a subjective endeavor. Technical analysis is open to interpretation by the observer, which makes it more of an art than a science. The beauty of technical analysis is that each person is free to use any approach in any way they want. However, it is important to understand that technical analysis is not a magic formula that guarantees profits. It is merely a tool that can be used to increase the chances of making successful trades. It is essential to approach trading with a clear mind, free from emotions, and to manage risk appropriately. Ultimately, technical analysis is about using your intuition, experience, and knowledge of market patterns to make informed decisions. It may not be a science, but it's certainly an art form. Technical analysis is a popular approach to trading in the financial markets. However, the reality of technical analysis is often different from what many traders expect. It is essential to understand that the market is influenced by many factors, including buyers and sellers, stop hunting, liquidity, short squeezes, momentum spikes, and shock events. Technical analysis should be used in conjunction with other market data to make informed trading decisions. It is crucial to approach trading with a clear mind, free from emotions, and to manage risk appropriately. So, the next time you think you found the holy grail of trading patterns, take a step back, and consider the bigger picture. By combining technical analysis with other market data and managing risk appropriately, traders can increase their chances of making successful trades. Remember, trading is a game of probabilities, and while patterns can be a useful tool, they are not the be-all and end-all. Keep an open mind, stay informed, and most importantly, manage your risk. Thanks for watching. I hope this video has given you a better understanding of the subjective nature of technical analysis. Please support us by liking, subscribing, and hitting the notification bell.